It's time for the Phil Ferguson Show.
Benvenuti a tutti. Welcome, everyone. This is Phil Ferguson, and of course, you are listening to the cleverly titled The Phil Ferguson Show. We have a couple of investing skeptically topics today. These are both driven, at least in part, if not in total, from listener emails. So please keep the emails coming in. You can send me ideas or questions, things that you'd like to talk about. The email address, phil@polarisfinancialplanning.com. So we've got that covered and out of the way. The two topics are Covered Call ETF. And the basic idea is that it's an ETF or a mutual fund kind of thing. It holds a whole bunch of stocks. And it writes calls. And they don't have to normally sell the stock. And they just hold the stocks and make the income from writing covered calls. Sounds so straightforward and easy, but is it? Is it really easy? The other one is how to build the cushion, and I go over this, of course, in the segment, but a couple of listeners had thought that maybe I hadn't covered that specific detail of the Polaris plan, so I went into excruciating. No, it's going to be fine. I went into detail about how one builds the cushion, and it's kind of a really good idea because I've said before, and I want to make sure I give my preamble, I am not saying to panic. I am not saying that the sky is falling. I am simply at this time recommending another incrementally small step towards being conservative. That's it. It's just time. We've made a lot of money over 12, 13, maybe 14 years now since the '08 drop. If you are still way far from retirement, 15 plus years, don't worry about it. I mean, it seems like there's a lot of bad things in the news today. Well, that's what news does. It often has bad things, and some of them are bad, but there's always bad things. And I like to remind people that over the last 100 and plus years, 120 years, we've had World War I, World War II, the Great Depression, Vietnam, George Bush, Trump, all these things that I consider horrifically bad, oil embargoes, all kinds of things. And they can, and again, I'm not saying it will now, but sometimes the events that happen in the real world dramatically affect the stock market in the short run. But when is that? I mean, I remember back 6 years ago when Trump first got elected, and I had a few clients that wanted me to sell everything. Well, are you fucking glad that I talked you down? I hope you are, because you made a lot of money. I mean, in the last 5 years, I think the market's more than doubled. We may not have doubled, depending on your situation. If you had some bonds because you were building your cushion, or international has still underperformed, but only by a teeny bit compared to a lot of bit from before. So that's some fun things. Another thing, just kind of a very mini recap, because I try to not do this more than once a quarter, and I definitely don't want to do a full one except once a year, because I don't want people thinking that this is a valuable thing to do. I'm gonna give you some end of September quarter ending numbers on how different investment categories have done. Let's start by looking at some bond funds here from Vanguard. For a while now, I've been recommending a very conservative stance, I guess, very conservative investment style, even within the bonds, because you can buy very conservative bonds, you can buy very aggressive bonds. And maybe I shouldn't use the word aggressive. You can buy very risky bonds that have a chance of paying out a generous amount of money, even in today's environment, but that almost always means they have a chance of losing a lot of money. Anyway, a few examples. The short-term, which one is this? The short-term government bond fund. I think I've got this right. Year to date has made 0.14%. 0.14. A very small fraction of 1%. And basically nothing. They made basically nothing. Kind of expected, at least on my part, that it was going to make basically nothing. At this point in time, the cushion is mostly to protect you from any possible market correction. This is, again, for people in or close to retirement, 10, 15 years out. You should have a bulk of your investments in things like this. I use short-term government, short-term corporate as, and Jenny Mays as the real anchor for what you can make, at least, or how you can protect your money while making a little bit. And this 0.14, that's basically zero. It's a rounding error, but it's a lot better than some other funds. So as an example, I'm going to look at, let's see, where is this long-term? Yes, U.S. long-term government bonds. And these are the same types of bonds that are in the previous fund that I mentioned, but the previous fund was short-term bonds that are due with an average duration of 2.8. And duration is an indication tool you can use to figure out how much your individual bond or your bond fund or your bond index fund can go up or down as affected by interest rates, changes in interest rates. So if a bond fund has a duration of 2.8, like the short-term government bond fund, if interest rates go up 1%, that's going to create a negative pressure of about 2.8. So if your bond fund is paying a pathetically sad 1% yield, and I don't even think this fund makes 1% currently, but if it were to pay 1%, it would go up 1%. But if interest rates go up 1%, you're going to make positive 1.8 from the dividends, or I'm sorry, positive 1% from the dividends, and minus 2.8 because they became less valuable. So you could end up minus 1.8% in a year if interest rates go up an entire percent. Not horrible, but your upside is very limited, and your downside, thankfully, is also limited. So you're not really going to make much. But the long-term bond fund, the long-term government bond fund from Vanguard, the symbol for this, just for laughs, VLGSX. Its duration is 18. If interest rates go up 1 percentage point for this category of bonds, this fund could lose roughly 18%. So it might pay almost 2% as a yield, way better than the 0.5% from the short-term bonds. And you might think, Phil, I'm missing out on that 1.5%. Yes, you are. We are intentionally missing the fucking 1.5% because I was very concerned about something that could happen that seemed to not happen year after year. We danced with it a little bit in the first and second quarter of 2020, and then it got better. But now it looks like it may be the time where this is not going to get better. Specific to this investment idea, this little teeny granular idea, the granularity of why I like doing what I do, where I can see exactly what type of investments I have. I don't want just a target date fund if I can avoid it. But anyway, the long-term government bond fund from Vanguard is down about 9% year to date. And it's down slightly over 10% for the last 12 months. So if you had money in there thinking, yay, I'm going to make 1.5% more, 2% versus the 0.5% in the short-term bonds, if you hold them to maturity, that could happen. But in the short run, and the cushion is to protect you in the short run, you got whacked. 9% loss. I mean, the stock market's up, yay, so you don't have to really worry about it if you're taking money out. But if the stock market had gone down, and maybe at the same time the Fed increases interest rates and interest rates go up even more, this fund is phenomenally sensitive to interest rate fluctuations. It's not in and of itself a bad investment. I have used this fund in the past when interest rates for long-term U.S. government bonds were 7, 8, 9%. This was freaking amazing, not only because you might make 7% yield, but if and when interest rates ever go down, your value goes up on top of the yield that you're getting, which is what happened from the late 90s, even the early 90s, late 80s. Long-term bonds have just reliably made really, really good money. Matter of fact, here, let's see, the long-term performance on this fund since 2010, March 1st of 2010, is a positive long-term return of 6.5% per year. And you might think, hey, Phil, that's amazing. Yes, it is. The current bond is under 2%. The current yield is a very strong indicator of what you could expect to make in that fund over the next 18 years. About 2% per year on the upside. But in the short run, if interest rates change, you can get hit. There's almost no chance, I hope, that interest rates are going to go down anything materially, but they might go up. So if interest rates went up 2% over the next 4 or 5 years, since the duration on this fund is 18, you could lose 36%, 30, 40%, somewhere in that ballpark. Who knows? Depends on what day you look. I don't want to make an extra 1.5% if I can lose 30 or 40. So that's something I'm definitely staying away from. And kind of one of those things that I got really lucky, I guess. I mean, by paying attention to what's going on. And so people that listen to me or people that hire me, if we've done this in your portfolio, if you've done this in your portfolio where you've stuck with the really conservative stuff, you've made almost nothing, but that's way better than minus 9% in the last 8, 10 months, 12 months. Another thing, the total bond fund, the Vanguard Total Bond Fund, which is nice, but again, it owns everything, and that's fine. You know what? If you're a mutual fund or you're a 401k and you're 30 years from retirement, and the only good bond fund in there is the Vanguard or the Fidelity or the Schwab Total Bond Fund, fine, whatever. If you want to put some money in there, that's a reasonable place to put it. But that fund year to date is down 2%. Not a huge loss, but an expected loss because the things that have done well in the bond market versus the things that have done poorly in the bond market, you get the blended result of minus 2%. And again, if you were in retirement and this was your only investment in the cushion, you would now be compelled, if you sold bonds, to sell at a loss, which again, minus 2%. If the market's down 25, 30, 40%, if your bond position is only down 2, that's great. Minus 2, it looks way better than minus 35. And now I'm going to jump down to high yield bonds, AKA junk bonds. I don't want anyone to ever accuse me of hiding these are also called junk bonds. It means that they're very risky. And these bonds have made 6.5% year to date, 8% over the last 12 months. Absolutely amazing. Again, these are in reference to the Vanguard Bond Fund. I'm looking at VWEAX. That's the Vanguard High Yield, AKA Junk Bond Fund. So if you needed to sell bonds, that would be a place to sell at this time. The total blended 1-year performance from a portfolio like I might suggest, and again, this is not personal investment advice for any of you, but 75% of the money or more would be split up in short-term government, short-term corporate, and Ginnie Mae's. The other 25% is split up in 3 parts of the total international bonds, emerging market bonds, and high yield, aka junk bonds, which is not necessarily limited to the United States, but often is. That blended portfolio of bonds made 1%. Whoopee. But positive 1% is better than the minus 2% from the total bond market index because it had other types of bonds that didn't do as well. So there's a approximate 3% improvement that you might have gotten by understanding bonds, by understanding which parts to be in, and having this, clarity and granularity, the clarity that you can see exactly what you own and don't own. And then you have the granularity where you can go in and tweak it, because you'll often have half a dozen bond funds that your advisor may give you. Well, what do they do? What do they have to do? Do they slosh around and do other things? I don't know. I'm just going to jump to the stock market performance. I'm not even going to give year-to-date numbers, but they're in the same ballpark. These are one-year numbers ending September 30th. And just as an example, the S&P 500 for 12 months ending September 30th is up 29.98, 30%. Absolutely staggeringly amazing. The extended market, which is everything in the U.S. stock market that's not in the S&P 500. So the S&P 500 plus the extended market in the right allocation percentages equals the total stock market. So, you could just get the total stock market, but then you lose control over breaking apart large cap from not large cap, mid cap and small cap. As an example, the total stock market, S&P 500 about 30% up in 12 months, total market 32%, extended market 42%. So you can see that the total market is only 2 points higher than the S&P 500, which is nothing like the 12% higher the extended market is, which also shows you from a mathematical standpoint, if you want to create an average, that the vast majority of the money in the total stock market is the S&P 500. So if you have only a few $1,000s, getting the total stock market or the S&P 500, they're different, but they're not that different. And this is one of the reasons why right now, out of the total stock market, probably 15, 20%, 23% maybe is not the S&P 500. 75%, 80% of the total stock market is large caps. They always have an overweighting. And so to balance out of that, currently at this time, and my recommendation still stands, but we've been here for a couple of years, is that you should have about 50-50 between large cap and not large cap. Not large cap means mid cap and small cap. And so if you had just S&P 500, if you had just mutual funds that were tracking the S&P 500, they love the S&P 500, they're trying to get to the S&P 500 and match it with a slight fee increase for you because they want to make money and they're not Vanguard, cool. You might have made in those portfolios something around 30%, maybe 28, 27%, depending on how sloppy they are or how high the expenses are. But you didn't make the 42% of the extended market unless you had small cap stocks. So sometimes my gut, my plan, my strategy doesn't work. Well, this is one of those times where this worked great. Better than I expected, honestly. So in the short term, mid cap and small cap have really outperformed large cap by quite a bit. So 30% versus 42%, big difference. And of course, you can look at all of your stock mutual funds or the stock portfolio that you have if you have someone that's picking stocks for you, and just look over the last 12 months. Have you made 30? Have you made 40? Did you make 15? Did you make 15 and think that 15 is great because the average year is 10? Well, this wasn't an average year. So just something to think about. The other thing that I've been recommending for a year and a half, actually, since right after the big drop in March of 2020, so that's about a year and a half, we have been overweighted in value versus growth. Now in the large cap, the growth index is up 28 and the value is up 32.5. So yay, good educated guess there. In mid cap, it's 32 versus 41. That's nice. And in small cap, it's 31 versus 56. 56. Oh my God. Yes, small cap value, which thankfully is extra overweighted because I'm doing 50-50 in large cap versus not large cap. And then I'm also doing a kind of a 40-60 within small cap growth versus value, mid cap growth versus value. So we have, well, at least we had a reasonably larger percentage than what we would normally have in small cap value. And in the last 12 months, again, this is the Vanguard Small Cap Value VSIAX fund that in the last 12 months made 56%. Yay. How cool is that? Another fund that I recommend, and we've done shows on this, even kind of philosophically debating why in the fuck I use this fund. But here it is. It's the REIT fund from Vanguard. Nothing wrong with it. It was just a esoteric, philosophical, very profound thought process. Again, inspired by a listener email. So we had a lot of fun with that. Up 33%. International did pretty well. I mean, most of them are 24, 25%. The International Value Fund, which again, luckily, we had slightly overweighted, has made 31, while the International Growth has made 25. So not a huge difference, but it's nice. And I guess not surprising, given the pattern in the United States, the total International Small Fund from Vanguard has made 30%. So just some thoughts, some ideas. What kind of return numbers should you have? Well, it depends on what type of portfolio that you're going for. If you have only U.S. stocks, matter of fact, if you have only the S&P 500, you made about 30%. Okay, look at your portfolio. If you can break it apart, if you can make a spreadsheet, if you can do the calculation, whatever. If the U.S. stock part of your portfolio didn't make something close to 30%, now it doesn't have to be 30. It could be 29 or 28 or whatever. But if it's 15, what's going on in there? How is this? How did this happen? You might want to look into that. If it's considerably more than 30%, it might mean you have a lot of small caps, which you did fantastic. So 40, 42, if you're overweighted in small caps, if you are overweighted in value, maybe you made over 40%. That's nice. That's a really nice year. In the international part, maybe you made 25. Maybe you made 22, maybe you made 30, but just ballparking, because these numbers are kind of big, and it doesn't mean we're going to make any of those numbers going forward, but it's kind of nice. And the bonds 1%, and that's really all you're going to get going forward. If we make more than 1 or 2% in the next year, I will be surprised. And probably the only way that would happen is that if interest rates fall again. And I'm not seeing that. But, what do I know? So a portfolio that maybe has 20% in the cushion, and then the rest all in stocks, and the bulk of that is U.S., maybe 30% of the stocks are in international stocks, you might have had a total return of your portfolio of 24, 25, 28%, give or take. And the fun thing is when we look out long term, we're looking 20 years, roughly, 20 plus years, with the average returns that we've gotten from domestic and international stocks and the average returns from bond funds, you might have made 8 to 9, close to 10% per year for the last 20 years, depending on the exact start date that you use. So it's been very, very good. If you are in a blended portfolio of stocks and bonds, depending on the portion that is in bonds, I don't think you're going to make that over the next 10 years. I think stocks will be okay. Of course, we might have a 30% correction as soon as you hear this episode, because I don't know the short-term future. I don't even know the mid, intermediate, or long-term future. It's just educated guessing that in the long run, the stock market makes, give or take, 10%. But what worries me is the bonds, because the long-term number for bonds is 4.5%, 5%. You are not going to make that unless you have a whole lot of long-term and or junk bonds, which is not what I'm recommending. Matter of fact, look at this here. Long-term government bonds. No, this is long-term corporate bonds. Since 2010 is up 7.5% per year. Junk bonds are up 8% per year since 1978. That's how far back this mutual fund goes. So there's chances that you can make some money, but I don't think you're going to make a blended average of 5%. For the next few years, 2% is going to be looking really good. So if you were half bonds at 2% and half stock at 10, add those two together, 10 plus 2, 12, divide it in half, 6 might be what you could kind of sort of hope for in a 50-50 portfolio. Now, what's the right amount of cushion for you? That's a whole nother segment. And of course, none of it would be specific investment advice, but just some ideas about how the market has done over the last 9 to 10 months to 12 months for the year performance numbers ending September 30th, of course. We'll take a quick little break and we'll go into our other little segments. And don't go anywhere.
My name is Annie Druyan, and I'm founder of Cosmos Studios and an honored to have been the longtime collaborator of Carl Sagan. And I'd like to say that I think it's just the opposite of what you're saying from my perspective, humbly. One is that I think that science tolerates the unknown in a way that religion doesn't. My argument is not with people who search for God. My argument is with people who feel that our understanding of God is completed. And those are the people who make so much of our existence on this planet such a hell, because they really think that they have the right to kill other people, to hurt them, because of what they understand God's will to be. That's a very destructive thing. So science is, the whole methodology of science is saying that we are not permitted these absolute truths that religion pretends to have, that we do not know the answer to these questions, and not only that, but the little that we think we do know, if you can prove us wrong, we'll give you our highest reward. And that's part of the methodology. That's part of the whole functioning of the system itself. So yes, in answer to what Joan was saying earlier, scientists do terrible things. Scientists have biases. Religious people do terrible things, and they have biases. But absolutely intrinsic to the whole the methodology of science is that error-correcting mechanism, which says we must never lose sight of that. That's not in religion. That's not present at all. Talk about humble. It's the fact that we do science and that we can bring ourselves to see that little tiny earth in Carolyn's presentation. That is humility. What science has done for us spiritually is that it has been the only thing that I know of that has compelled us to wean ourselves of our infantile need for centrality. And that was present, that is very much the essence of so many religious formulations of where we come from, why we came to be. It's the sign of mental health, that we can bear to think that this planet was perfectly fine for 4.5 billion years without us. That cosmic evolution goes on for 13.5 billion years before we even get here. How long have we been in science? How long have we systematically been looking at nature? Not even 400 years. And yet science gets us out to Enceladus. It takes us out of the solar system. It enables us to wean ourselves of that spiritual narcissism which compelled us to be at the center of everything. So when it comes to humility, when it comes to a tolerance for ambiguity and for the unknown, I think science worships the unknown. I think scientists are most comfortable in that place of not knowing. And that's where they live. And that's the great strength of science. So I would respectfully disagree.
You're listening to The Bill Ferguson Show.
Another mailbag topic for you. This is about how does one start building the cushion. So the basic gist of the email is that they haven't heard in a while. And I have covered this some in the past, but maybe I'm due again. And this is a great reminder for me to do this. They said, Phil, you've talked about the stock part and how you balance that and what portions you have where and when. You've talked about the cushion and what's in that and what the ratios there might be. You've talked about, recently I've talked about how to take money out, whether you take money out of stocks or bonds in a given year or quarter or time period, depending on what has happened and what you think might happen going forward. But he says, you haven't covered, at least they haven't heard lately, and it's probably been a while, how does one build the cushion? So we're going to start with the premise that when you're farther from retirement, 15 years plus, you're probably going to be 100% stock. That's a perspective from my point of view. I think that's how you maximize your portfolio and your growth over time and get the best results, maybe that's not right for everybody. So none of this, as always, is personalized investment advice, but it's an idea. It's something you could pursue. And of course, all of those stocks are in Vanguard ultra low cost, or virtually all those are Vanguard index funds. But at some point, you want to have a cushion, because what you don't want to have happen is retirement is 1 year away or 2 years away, and the market does like it did in 08 calendar year, it dropped 37%. And so suddenly the great big juicy portfolio that you had, that you were just getting ready to retire, suddenly loses half of its value. Are you going to be okay on half of the expected income that you were going to have? Now, in some cases, maybe you are. If you have rental income or income from somewhere else, or you have a big pile of money in your local bank that you should have invested, but you hadn't. If you have Social Security, or if you can work a part-time job in retirement that you really like and you don't need as much money as you thought you were going to need, there's ways around it. But for some people, losing half of your portfolio in a year and a half, 2 years, whatever it takes, you suddenly find yourself in a position where you are about to retire and now you can't. And with a little luck, in 3 or 4 or 5 years, the market will come back. And so far throughout history, it has. Every time there's a big drop, there's a big recovery. It might take a couple of years, but it doesn't take a terribly long amount of time normally. In the spring of 2020, the market fell as much as 30% or more in a month or two. And then within a year, it had recovered all of that, maybe even within 6 months. So it can be very short, but it could also be something like the dot-com bubble crash in 98, 99, 2000, where the market went down 50+% over 2 years plus, and it didn't fully recover all the way until 07. And then, of course, you had the problem with 08 followed that. So this is why you have to hedge. So for discussion purposes only, I am going to say that you need 40% in bonds and 60% in stocks at full retirement, at your retirement date. This number is not the right number for you. It is a theoretical example. The right number for you might be 27% bonds. The right number might be 54% bonds. Generally speaking, I don't even calculate it as a percentage. I calculate it as a dollar amount, because in my system, I want to know how many years the cushion will last. It's trivially easy to calculate the percentages, and so sometimes we fall back onto that. But for me, the goal is stock dividends, bond dividends, and then selling bonds if necessary in retirement. How many years in a row can you do that while you wait for the stock market to recover? So I will often refer to the cushion in size as a number of years. I am not aware of anyone else doing that, but I'm sure I'm not the only person that thought of this. So at full retirement, or I don't want to use full retirement because that's a Social Security kind of sounding word, at your retirement date, the day you're going to retire in 2021, you should have enough money in your portfolio. And again, for the purposes of math, we're going to say for you, and only this person in my theoretical example, not any listener, the right amount happens to work out mathematically to 40% of your portfolio is in bonds. Cool. How do we get there? Historically, I plan to be at that point 1 to 2 to 3 years before retirement. You want to be completely ready several years before retirement. You want to actually have that 40% on hand in the cushion, so that if in the last year or 2 or 3 something terrible happens with the stock market, it doesn't really affect you. It's a bummer. You might even cry when you open your statement, but don't panic. You have a system. You have a plan. You have the Polaris plan. But 40% of your money was protected. It may not have made much, but it didn't lose much. And so you take all your dividends and everything, and you can retire on schedule as you wish, or you can work another year or 2 if you want, but it's your choice. You're not being forced to change your life plans because an outside force fucked you. So as I said, I usually want to be a year or 2 or 3 in advance of retirement, having the cushion fully funded. That's normal times. Currently, I'm suggesting 5, maybe even 6 years in advance. And you might think, well, Phil, why is it different? It's different because since 2009, with a couple of corrections and I think 1 year where the market was down a percent or two, we, you, I, everyone who's been invested in the U.S. stock market in particular, has made a lot of money. That's cool. And maybe if you're 20 or 30 or 40 and you're not close to retirement, maybe you will make a lot of money in the next decade as well. But if you're getting closer to retirement and you've made a crazy amount of money, I mean, we're talking about portfolios doubling and tripling. Let me see, what is the Vanguard Large Cap Growth Fund, just as an example. If you had put in $10,000 10 years ago, it's worth $56,000 today. That's crazy. 5 times. Is that right? Am I looking at 10 years? Is that just 10 years? 10 years average return, 19% per year. That's cray-cray. Will it continue? I don't know. I'm not making a prediction here. That's not the point of this segment. The point is that you made a lot of fucking money. You put in 10,000, you got 56,000. You put in 100,000, you got 560,000 in the Vanguard Large Cap Growth Index funds. The other segments of the U.S. stock market and the international funds haven't done as well. So from a perspective of a broadly diversified portfolio of multiple index funds and some bonds, maybe your 100,000 is now 200,000 or 300,000. Still a lot of money. And of course, hopefully, as you're approaching retirement, you've been adding money to that. So why not? Why not just pull some off to the side? There's an old saying in the investment world, bears can make money, bulls can make money, pigs get slaughtered. So when you make a lot of money in the gambling, in the stock market, in investing, sometimes it's nice to pull a little bit off to the side. So for me, I think your cushion should be ready no closer than 4 years, but maybe 5 years is better. Maybe 6 years is better. Depends on your situation, the details and how much you have and all that stuff. And of course, if you want to go over some of this in a little bit more specific scenario, you can write me an email, Phil@Polaris Financial Planning. And of course, with clients, we sit down and we go over this in much more detail and explain it as many times as you need. The bad part, or the really fucking cool part, is that currently for new clients, I'm only taking clients with 2 million or more of assets under management. And I'm ecstatic about that, but bummed because I can't help a whole bunch of more people other than with the show. So this is the free way to do it. So you want to be ready in advance. You don't want to have 1 year from retirement and the market falls and it ruins your plan. You want the cushion to be prepared. Well, when do you start building the cushion? I'm now thinking 15, 16 years out. So if you're going to retire at 65 and you're now turning 50, you want to start building the cushion. And to make it oversimplified, I'm going to again use the percentage. 40% is your target. And let's say your target is 5 years from retirement, you want to be at 40%. If you're going to start 15 years out with 0% in bonds, I want you to gradually increase your percentage of bonds in such a way that you go from 0% bonds to 40% bonds over 10 years. You could look at that as about 4% per year, which is cool. If you're 15 years out from retirement, you want to have $2 million, and maybe now you have $1 million. That's a reasonable number if you make 7% per year, because I don't think going forward, and I definitely don't plan on it, that you're not going to make 20% per year like not the S&P 500, but the large cap growth stocks did. You may not even make 10% in your entire portfolio. Maybe you only make 7%. And if we use the quick and easy cheat code for the rule of 72, if you make 7% per year in 10 years, 7 times 10, 70 is about 72, your portfolio could double. So let's say you have, and so we're talking about 15 years here, but we're talking about getting close to retirement. So if you have $1 million today and you're 15 years out from retirement. So you're 50 with $1 million. You want to have at least $2 million when you're 65. And I'm keeping inflation out of this just to keep this simple. Well, if you're 15 years away from retirement, now is the year where you could make 4% of your portfolio into the cushion. I also would not have any problem if you look at the success that you've had over the last 10, 12, 13 years, and you said, okay, I've made a lot of money. It doesn't necessarily seem like a lot of money because starting up, ramping up, how long it took you to get to $1 million may have been the last 30 plus years. To the idea that you're going to double that in 10 to 15 years can be staggering and amazing to think about. But you spent a long time to get to $1 million or whatever the number you have is. Because everyone has a different number. I'm just using it again for an example. And you say, okay, well then now I need $40,000 of that million to be in the cushion. Well, how does the $40,000 get there? Well, if you're still saving for retirement 50 grand a year, and maybe you can't do that. Maybe that's not the number for you. But if you're saving 50 grand a year between you and your spouse and your company match and 401ks or gifts from your parents or rental income, however you're doing it, if you can save 50 grand a year, you put 40 grand in the bond funds that I recommend, and then you put 10 grand into stocks. Voila, you now have about, give or take, 4% in the cushion. You could, and I would not be opposed to this at this time, after so many years of such wonderful, delightful success in the stock market, say, hey, you know what, Phil, I'm just kind of going to leap ahead a little bit, and I'm going to put 10 or 12 or 15% into the cushion. Now, you're protecting that money earlier than you necessarily need to, but you've made a lot. So I'm okay with that. I don't know that I want you going to 25 or 30 or 40% now, because you've still got an entire fucking decade before you need the cushion to be fully filled up. But you could. In normal times, when the market's plus or minus 10% per year, and there's no big ups and there's no big downs, and maybe this time period never exists, you put 4% in one year, you put 4% in the next year. You keep doing that, and you're going to get close to 40% of your portfolio in the cushion over the 10-year time period, from 15 years prior to retirement to 5 years prior to retirement. Voila. If you don't have money to add, you can sell something. You might want to start within your 401k or within your IRA, because when you sell whatever has gone up the most in those types of accounts, you don't create tax consequences. So let's say you're adding no new money. You just don't have any money, and you're counting on the $1 million doubling to $2 million by the time you get to retirement. Then you're going to have to go and sell $40,000 of something. And it would be a great opportunity when you're rebalancing. You're doing your once a year rebalancing. And maybe you get a year where you don't do rebalancing, but let's say this is a year that you're doing rebalancing. You do the rebalancing, and you do it in such a way that you trim out $40,000 from stock index funds, and then you put that $40,000 into bond index funds. Now you have 4% in your cushion. If you decide this year that you don't want to do just 4%, but you want to do 13%, whatever number you came up with, okay, sell stuff if you can inside of an IRA, inside of a Roth IRA, inside of your 401k or 403b, your TSP, your deferred comp, whatever account you have that is a qualified account, qualified for magical special tax treatment, a la no taxes when you perform activities like this. You can do the rebalancing there to avoid taxes. If your case is different, and again, this is why it's so difficult, this is not specific investment advice, you might have something that's gotten really kind of out of hand. Luckily for you, it's gotten too big and it's in your taxable account. And it could be that one random stock that you bought that worked because the other 10 that you bought sucked and you sold them long ago, but you've got one left over. And now it's getting out of hand. It's getting too big. Maybe you want to sell some of that to limit your exposure and your risk to one investment. Maybe in your portfolio, maybe you haven't adjusted for a couple of years, and the Vanguard Large Cap Index, if you're following Phil's plan, is now not only too big for the original plan that you have, but definitely too big for my current recommendation of the allocation for the large cap growth index fund at Vanguard. So you might end up having to sell there. Again, this might not be horrible depending on your income, because long-term gains tax rate is 15%. If you are doing really well, it might be 20%. And it can be even higher, but that's for very few people. But you could sell that and pay those taxes. Maybe you do a mix where you sell some of that and then you do some adjustments in your IRA or 401k. So that's kind of how you can build the cushion. You can build it with new annual contributions and let the stocks keep on rolling. If you're not contributing enough, or you're not going to be able to contribute enough, you can sell some stuff, whether it's in a qualified or tax avoiding account, tax deferring account, or in a taxable account. Because you want to be in the position that the closer you get to retirement, the more the cushion is like the full amount you're going to need at retirement. And I'm doing that a little bit more aggressively than I have in past years because the stock market's done so very well. And I'm not making any prediction about whether the market's going to go up 20% in the next 12 months or down 50% in the next 12 months. I'm not even going to average those two numbers. I have no idea. And one of the beautiful things, one of the most valuable things I can tell you is I don't fucking know. Because as soon as you think you know and you start taking action on that, you're going to cost yourself transaction costs, tax costs, and you're going to miss upside opportunities. It's really, really hard. Almost no one ever is correct in timing the market. And of course, even if you are correct in timing the market, you have to know when to get out and you have to know when to get in. So you have to do it twice at least correctly. And you have to be smart enough and right enough to cover all the transactional costs and taxes that you created for yourself. So it's not easy to do. Almost no one does it. And one of the best things I've ever done for myself and for my clients is to acknowledge I have no fucking idea. So we ignore the theoretical what's going to happen. We look at where we are. We look at where we want to get to 10 years from now. And we can look a little bit at how we've done. Because if the market's made 10, 15, 20% per year for the last 10, 12 years, we can be a little more aggressive at scooping the cream off the top and putting it into the cushion. If I was having this segment, this conversation with you a year from now, again, theoretical, not predicting, but let's say the market falls 50% between now and 1 year from now. Now, I would not be saying is the time to add money to the cushion. You want to keep money in the stock market, or if you add new money, you want to add it to the stock market because it's on sale, at least compared to where it was 12 months earlier when I'm talking to you today. That's weird. So the answers change over time. I have had in the past, at 2008 was an example, where some people had fully recovered, most people had fully recovered from the 1999-2000 dot-com crash. And their portfolio grew again, and we get things balanced, and maybe they were a little more gun shy, and so we had more money in the cushion. And then 2008 happens. If you are a particularly aggressive investor, and you find yourself where you have 40% in the cushion because you're getting close to retirement, and the 60% of your portfolio that's stocks falls by half, it now becomes, well, 60% would be cut in half to 30%, but your entire portfolio went down 30%. So it's now less than 50% of your portfolio instead of being 60%. Maybe it's 45%. One could now use that opportunity to sell some of the bond money that you had that made 1 or 2% and now go and buy stocks that are on sale 50% off. Maybe that works for you. I know I had some people that did that, and they were rewarded immensely. We talked about the numbers for the last 12 or 13 years. Other people said, no, this is why I have the cushion. I'm comfortable. I don't want to do any games. And the part that was in the stock market 2 or 3 years later, 4 years later, had all come back anyway. So it gives you options. One thing I definitely do not want you to do is to start taking money 10 or 20 or 30% and setting it aside for the opportunity when the big dip happens that you can put it back in, because we don't know when that's going to happen. It happened last year in 2020 in March, If you happen to have cash on hand, you were able to buy on sale. That was pretty fucking cool for the few people that had cash, either intentionally, which I don't recommend, or accidentally, or got a bonus or whatever and hadn't invested it yet. Great, you got to buy on sale. But don't set money aside waiting for a 15 or 20% sale, because the market might go up 25 or 30% and then down 20%, and you say, now it's on sale. Well, you would have been better off putting it in 2 years ago and making the money, and even with the drop, you're still ahead. So you don't know when they're going to come. So don't play that game. Don't time the market. And these ideas about the cushion and stuff, they're kind of, I don't know, invariable, but flexible, because I'm not completely blind to what has happened over the last 10 or 12 years. The market's done really well. Pocket some of that, I guess, I'm okay with that. Anyway, I hope that answers that listener's question and maybe some other people's questions about how and when do you specifically build the cushion. And again, if you want a little bit more guidance, you can send me an email, phil@polarisfinancialplanning.com. Just keep in mind that with an email, I'm going to know very little about you. Maybe we talk briefly and I can give you some pointers and ideas. But that wraps up this segment about how and when to build the cushion. The Phil Ferguson Show is for educational purposes only. Nothing said on the show should be interpreted as personalized investment advice. Your investments should be based on your situation, and you should consult with your financial advisor before taking any action. The show may contain ads. These ads are placed into the show by the hosting company after I finish recording and editing. I have little control over the content of the ads, and you should not assume that I support their products or claims. If you choose to support the show via the new Patreon page, that support does not create an advisor-client relationship. This is another topic from the mailbag, and again, thank you everybody who sent me a lot of really cool ideas. Thank you very much. One of the listeners to the show said they're being introduced by a coworker to a thing called a Covered Call ETF. And their coworker is telling them about how much money they're making and how easy it is and how it's safe and all that stuff. So this is one of those things that it's probably not a super shitty fund. It might not even be a shitty fund. But you do need to know what it is you are investing in. You can look this up on Morningstar, and as my listener noted, there wasn't a whole lot of details there. Morningstar doesn't cover everything in full detail because there's just an endless number of things. So I actually had to go to the website of the company that manages this, sells this, whatever. And the fund is QYLD from Global X. And I went and checked it there. And of course, there was some stuff from Morningstar. So I had some ideas. But what this basically does is this fund buys the NASDAQ 100. And so they are buying the biggest, most growthiest stocks in the NASDAQ, which is a lot of technology stocks, but sometimes not specifically technology stocks. It's whatever the NASDAQ has in the NASDAQ 100. And again, this is something where Morningstar can help you. And this fund owns Apple, Microsoft, Amazon, Tesla, Google, NVIDIA, PayPal, Adobe, Cisco Systems, Intel, PepsiCo, Broadcom, Costco, Texas Instruments, T-Mobile, Honeywell, Intuit, Qualcomm, Moderna, Starbucks, things like that. So it owns a good chunk of companies that you would probably think of as big companies, a lot of them technology companies, and a lot of them are large cap, if not all of them, are large cap growth funds. I do have some concerns in that for example, Apple is 11% of the portfolio, Microsoft is 10%, Amazon is 8%, Tesla is 4.5%, and then Google is 7.5%, 8%, Facebook. So the top 10 holdings are 53% of this mutual fund. So That's not very diversified. So if it's something you wanted to use, okay, as a percentage, I guess it wouldn't kill me. But this is something that is definitely large cap growth U.S. stock fund. And then they hold all these stocks, and that's where they get to use the word covered, unless, of course, they just lie to you in the title of the fund. In this case, I don't see any evidence of that. They're covered calls. So they buy all these stocks, and then they sell calls. So what they might do is just pick a generic stock. The stock is currently trading at $102 a share. And so they sell a call, and this is kind of tricky. It's not super, super tricky or complicated, but it is kind of confusing. And you can go to Investopedia and look up calls, selling calls, covered calls, whatever words you want to look, and you can learn a whole lot about this. I'm not recommending that you do any of these things. I'm just walking you through how this works because I thought it was pretty interesting, and it's a little tricksy to understand. But so again, we have this random stock. It currently is on the market for $102 a share. And so you write a covered call, and maybe someone pays you $5 a share, and you get to keep that money. So you get to keep the stock at $102, and you get to keep the income from the share, from the stock, the call that you sold, the call that you wrote, of $5 a share. And what the person that paid you gets is the opportunity to buy that stock from you at a future date, at a specific price, a higher price. So they pay you $5, but they get to buy the stock from you at 110 at some point in the future. So the nice thing is that if the stock goes up, not only does your price go from 102 to 110, and then you have to sell it if they ask for it, if they execute the call within a certain period of time. If they never buy it, you just keep the stock and you keep the $5. So you have a $102 stock and $5 because you never sold it, which is kind of cool. So that's one way to make money off of stocks that you own. That's selling a covered call against the stocks that you own. Where the problem that can come in is that if this stock goes from $100 to $150, the person that bought the call from you will contact you. I mean, this is all probably more automagical than I'm portraying here, but trying to keep it simple. The person that bought the call will now execute the call at $110. So you had a stock that was worth $102 plus the $5 you got for selling the call, $107, and you now sell it at $110 if that's the agreed on bronze strike price. So you did okay, but the stock is now worth $150 and you no longer own it. So the person that bought it from you at $110 plus the $5 they gave you, they paid $115 and they can now sell it on the market at $150. So they made a whole bunch of upside money. Why would someone do this? They would buy a call because for $5, they have the opportunity to make a whole bunch of money. If the stock goes down, the person that bought the call is only out the $5 that they paid you. Now, you as the stock owner, you might think to yourself, okay, well, I'm just taking the regular stock market risks by owning these stocks, and I'm bringing in extra cash. If the market goes down, sure, I lose money, but I would have lost that money if I just owned those stocks anyway. So I have the same kind of risk on the downside with cash flow on the upside. It's a win-win. Well, you're forgetting that one of the reasons to own stock is that some stocks eventually go up a whole bunch, and sometimes that happens very quickly. You're going to lose all of that. You're going to get the cash flow, but you're going to lose the real true upside potential. Because people aren't just going around handing out ridiculous amounts of money to buy calls, and they expect to make money because of the money they paid you. They're not doing it for free. It's not magic. And again, the person buying the call is parting with some money, paying you for the opportunity to buy the stock at a specific price at a specific point in time. And again, the reason they do that is that they can enjoy virtually all of the upside potential at their choosing if the stock goes up. If the stock goes down, all they've lost is what they paid for the call. So their downside risk is very limited. Their upside potential is unbounded. You, as the person writing the call, selling the call, you own the stock. That's why it's a covered call. You're going to make the income. And if the stock goes up a whole lot, you lose all of that. If the stock goes down a whole bunch, you lose all of your investment. So you can have the same kind of losses if the stock market falls, plus a little bit of income from the calls, but you get very little, almost none of the upside potential, because you're trading the theoretical upside potential of stock appreciation for income. I hope that made sense. Well, the real problem of this comes down to, kind of the nitty gritty of what is the result, because this fund only has a published expense ratio of 0.6%. Not bad at all. And when you look at the 5-year performance number, one moment here, I'm going to go to the 5-year performance number. They've made 10.7% per year for the last 5 years. And you might think to yourself, wow, 10.7%, that's kind of stock market-like returns. That's not so bad. But you have to compare it to the right thing. You can't just compare this to the total stock market. You can't even compare it to the S&P 500, in my opinion. Because what they own are basically the same stocks that are in the Vanguard Large Cap Growth Index Fund. Let's just double check here. I'm just going to do this live in the recording. Now, what is in that fund? Apple, Microsoft, Amazon, Facebook, Alphabet, Tesla. Am I looking at the same thing? Wait. No. That's actually the Vanguard Growth Index Fund. So I bet out of the top 20, like 18 or 19 of them are the exact same percent. And even the Vanguard Large Cap Growth Fund has the same problem for me as 10.5% in Apple, 10% in Microsoft, 6.5% in Amazon. So these funds are almost identical in what they own. One just holds the shit. The other one is playing a game with calls. The published expense ratio is 0.6%. Here's one of the tricks that you're never going to know, and they're not going to tell you. The cost of managing and creating and writing and selling calls and processing them and all the trading activity that they're doing, almost none of that will show up in the published expense ratio. Transaction costs are not part of the expense ratio. The expense ratio is for managing the fund and some other things. And mutual fund companies include in the expense ratio only the things that are required by law to be included within the expense ratio. Because from a business perspective, you'd have to be fucking nuts to include in the expense ratio things that no one else includes. The shopper wants to look at apples to apples, and you think it includes all of the things that you might pay. It does not. It only includes the things that are legally required by the government to be included in the expense ratio. Writing calls and executing them, or when someone else executes them, there can be a lot of expense that you're never going to see that's in that fund. The other thing here, let me see what the turnover is. I don't even know what the turnover is. Because it's an ETF, it's not that easy to get. I'd have to get back to you on that. But the turnover is going to be a lot higher, I'm guessing, than the Vanguard Index Fund. So a lot more of anything that you make is going to be income. It's going to be short-term gains and taxed at your income rate, which might be 24, 28, 33. If you're in a high income tax state, maybe a combined 40%. Whereas if you just bought and hold, not only do you not pay tax until you sell, but when you do, you might pay 15% or maybe 20%. So your taxes on this could be a lot higher because of the dramatic activity. And a good chunk of the gains come from the revenue, the income of selling the covered calls. So even if they get to keep the stock because it didn't go up a whole bunch, they have to report that as income. So a whole lot of the money you make on this is going to be income, not long-term gains. So you might pay taxes, like I said, in the 30s versus 15 to 20%. So this fund has to do better, a lot better than the index to even have a chance of matching the index after you include taxes. If it's in an IRA, it doesn't matter. But if it's in a taxable account, this is maniacally important. So all of those expenses are not in the expense ratio. So I can only look at the performance. Let me go back here. This is the Global X NASDAQ 100 Covered Call ETF, symbol QYLD from Morningstar.com. It's been open for more than 5 years. Its average performance per year over the last 5 years is 10.7. Again, you thinking normal market returns, 10%, 10.7 sounds pretty good. I am now looking at the Vanguard Growth Index Institutional version, VIGIX. And let's look at its 5-year performance. I got to click on the performance tab. Come on, Morningstar, it's never fast enough. And the rate of return per year for the last 5 years for this fund, owning virtually the exact same shit, 22.3%. So you could make 11 or you could make 22. I'm rounding, make it easy. 11 or 22% per year. And don't forget that shit freaking compounds. So making 11% per year when you could have made 22% per year is comically, ridiculously dramatic underperformance. And you might say, but Phil, there's another thing that you forgot to mention about this fund and one of its big selling points. It has a very high distribution. If I look at the Vanguard Index Fund, let me see here, its current yield is about 0.5%. So if you have $100,000 in there, 1% would be $1,000. 0.5% is $500. A $100,000 investment, you're going to get about $500 in yield. So if you have the stock growth or the stock yields paying as cash, you can make $500 in a year. What if you're in retirement? You want a whole bunch of money being sent back to you. Well, let's look at this covered call fund again. And this is tricky. I've talked about this recently, the difference between yield and distribution, because this fund promotes that they pay out 10% per year. The distribution rate is 10% per year. Part of that comes from the revenue that they make selling calls. Part of it comes from the stock yield of about 0.5%, because it's the same shit that's in the other fund. And where does the rest of it come from? Well, some of it comes from stock appreciation. So they're selling stocks to be able to give you back part of your money. In this case, if they're making about 10% per year and handing you back about 10% per year, what you could have is an investment that you put in that was worth $100,000, and 5 years later, it would still be worth $100,000, which is cool. Don't get me wrong. And they've given you $10,000 per year. That's nothing to sneeze at, but this is why it's not necessarily a super shitty fund. But when we compare it to the index fund, if you had invested, let me see, 5 years ago, if you had invested about $26,000 5 years ago, where's the number? You would now have over $56,000. So if I make it $100,000 to start with, $100,000, it would be $250,000. So if you'd taken out $10,000 per year, obviously you would have decreased your performance here, and maybe it would be only $180,000. So in one situation, your $100,000 would turn into $180,000, and you pulled out $10,000 a year, or your $100,000 is still $100,000 and you pulled out $50,000 a year. So in one case, you have $80,000 more than the other. Which one do you want? Now, the downside is where you are not protected, and this is not a selling point of a covered call fund, because if you own a stock, go back to our initial example, that's worth $102. If you own that in a mutual fund, if you own it as a stock, if you own it as part of an index fund or an ETF, if it goes from $102 down to $51, you lost 50%. if you own that stock in a covered call and it goes from $102 to $51, you still lost 50%. So this fund reserves the right, because I could see it here in some of the notes, to not do distributions. So don't confuse distributions, the money that's coming from the fund, to being equivalent to yield, money that the assets are earning and generating and creating and handing to you. Because distributions can include up to 100% of the distribution can be a fund handing you back part of your money. And so my concern would be that if this fund continues to dramatically underperform its benchmark of the large cap growth index fund, in normal years when that fund is making 10%, this fund might make 2 or 3 or 4% if they still give you out 10% distribution. Every year your portfolio is shrinking 3, 5, 8%. And that can be fine if that's exactly what you wanted. But it's probably not what you wanted, because you got sold on the idea that you could own these stocks, get some upside potential, which you could, but it's very limited, and you get cash flow if the stock stays the same, which is true. So there's merits to it conceptually. However, as we look at this case, if I could choose to make 22% or 11% per year, I'm going to take the 22. Not just because it's 11 bigger. Although that's enough, it's the compounding effect that you're going to have wildly more money after 5 or 10 or 15 or 20 years just owning the index. And if you really need to take money out, then just take money out of the index. And of course, it'd be nice, you could even protect yourself in the situation by designing a portfolio that has some money in the cushion, and so you don't take from stocks in an off year or a down year. So anyway, that's just some information about a covered call ETF. And again, thank you to a listener for writing that question.
There are people who believe that dinosaurs and men lived together, that they roamed the earth at the same time. There are museums that children go to in which they build dioramas to show them this. And what this is, purely and simply, is a clinical psychotic reaction. They are crazy. They are stone cold fuck nuts. I can't be kind about this, because these people are watching the Flintstones as if it were a documentary. Now, there is a big difference between the Old Testament and the New Testament, and that is the New Testament God is really kind of a great guy. He is, especially when you compare him to the Old Testament God, who is a prick. I don't know what happened to God, over time, how he matured, if he went to an anger management class, or maybe just the birth of a son calmed him down. But before he had the kid, holy fuck, he was out of control.
You're listening to The Phil Ferguson Show.
I am delighted that you're still here. Thank you for listening to The Phil Ferguson Show. If you'd like to kick in a buck or two, or $6.66, you can go to patreon.com/Phil, P-H-I-L, about as simple as it gets. And you can kick in as little as $1 up to $6.66. Actually, you can create your own dollar amount. But you can give a couple bucks there. It doesn't really change my life, and I don't really need it. So if your budget's tight, give to somebody else over me. But, it's just something that says, hey, Phil, I like what you're doing. I appreciate it. The other things, of course, you can go give a review at iTunes, Apple Podcast, or Stitcher. I think those are the most reliable places, the biggest places that have reviews. So that would be absolutely fantastic for me. A couple of updates. It has been cloudy for many days now here in the Chicagoland area, so the solar panels aren't producing a whole lot. I'm kind of sad about that. It looks like at this pace, October is going to be a pretty bad month, almost as bad as December was last year. But we'll see. We'll see. It's no longer high sun season, so darkness and rain really, really blocks your solar production. Good news on my car, for those of you following along. My car is personally named McFlamo. It is the Chevy Bolt EV, and I adore it. And I've told you so many good things about it, and I've told you some bad things about it. It is under a recall because the batteries can spontaneously, under the right conditions, start on fire. And that's kind of a buzzkill. And of course, the really true EV fans like myself might point out that gasoline cars catch on fire sometimes too. Generally not just sitting passively, but it can happen. The rate is not particularly high, but it's a big problem. It's a big problem when your $20,000 to $30,000 to $40,000 vehicle self-ignites and burns up, and even worse, of course, if it's in your garage or by your house or if somebody's inside. And thankfully, to my knowledge, nobody's actually been hurt by one of these. But I think in one case, it did also ignite cars that were sitting next to it. The good news part of that, after all of that, is that GM, General Motors, and LG, I don't even know what LG stands for. Anyway, LG is the company that makes the batteries for a lot of car companies and a lot of other things. They're one of the biggest battery producers in the world. Samsung is also huge. But apparently during the manufacturing process from calendar years 2017 up through pretty close to today, there was one problem that occasionally happened in the battery packs, and even more rare was a second problem, and even more rare was both problems existing within the same battery pack. And from what I understand, and maybe it's because I'm being told by LG and General Motors, that it's a very small number of packs, but a car that has 60 or 66 kilowatt hours of energy in it has a lot of battery packs. So it just takes one. It just takes one. And when lithium starts on fire, it doesn't want to stop. That's one of the added problems that fire companies come and hook up to a fire hydrant, and it can take more water than putting out a house fire, an entire house fire, to put out a car, because you just literally have to drown it. But the good news is that they know what the problem is, and they've started manufacturing the replacement batteries, which the latest word I've heard, at least for my car, I think almost every single Bolt, is they're going to get an entire new battery. They're just going to unhook the battery, lower it down on a special jack, roll it away, roll in a new one, jack it back up, and I get a brand new, 100% brand new battery that will be backed by a brand new 8-year and a brand new 100,000 miles. So the 25 or 30,000 miles I've already driven don't count on the new battery. So that's very cool. Brand new 8-year warranty. And for me, people that had the Chevy Bolt EV model years 17, 18, and 19, we're actually getting a slightly different variation of the battery, which has 10% more energy in it. So 10% range increase for Phil. Very excited. So hopefully I get notified soon. GM is trying to do the cars in order of probability of fire, which makes perfect sense from hedging your risk. I don't know what all those criteria are, and it's not necessarily people that drain the battery and fully charge the battery, but it might be, it might just be the dates that the batteries were made in either South Korea or the United States. And during those dates, the quality was on average slightly less. So those batteries are slightly more likely to catch on fire. So that's some of the updates. The other update, I think I've mentioned this before, our cat is 15, 16 years old, and she is having, kidney problems? I think it's the kidney. It's kidney or the liver. I never got those two separated in my mind. We'll say kidney problems. And we've been giving subcutaneous injections of fluids, which requires us to dope the cat. Not really something I recommend for fun, if you're just looking for something to do. But it seems to be working quite well, because before, our cat was not eating as much as she needed to, and had been over a while, just slowly, gradually losing weight and becoming more finicky and picky. But yesterday we were extra successful and got her a very the recommended dose of fluids, because when she struggles, the needle comes out and it's awkward. But we did it better yesterday, and actually the few days before that, and her appetite is increasing. So we put down not half a serving, but in full serving, and she's done with it. An hour or two later, she wants to eat more. She's drinking way more water. She's even going back to eating the dry food, which she had not eaten. And I think that's from toxins that have built up from the organs not properly functioning. But with the subcutaneous fluids, that kind of helps pull out the minerals. I mean, it's not toxins. Yeah, sure, they're toxins, because they could kill the animal, the cat, if we leave them in there. But it's just minerals. It's not magical toxins like you hear on different advertisements. But yeah, so that's some fun stuff with us. And still kind of thinking I'm not really going to go anywhere. My most likely thing was to go to the FFRF conference in Boston. And I hope many people go, and I hope they have a great time. But I think I'm going to wait through the winter. Oh, man, I tell you, I'm looking forward to being somewhere at some point in time. But anyway, thank you for listening. More show topics would be great. If you have ideas for interviews, you can let me know. And if it's someone like really famous, if you happen to know them, that would help a lot. Because, I mean, just telling me I should interview Barack Obama doesn't make it happen. So anyway, thanks for listening. And hopefully I'll see you in the next show less than 2 weeks from today. And maybe next year, I'll see you out there somewhere in the world in person. Until then, ciao.
Well, I was born too late to play in the Rolling Stones. I don't know Jimmy Page, I never met Yoko Ono. Standing with a strap, I'm rock and roll's bastard son. Go out, get drunk, get laid, have fun. Don't got $1 million, don't drive a Cadillac. Give me half a chance, cause I'm not dead yet. Not dead yet. Not dead yet. I'm a mad dog fighting with the wall against my back. You better get a bigger gun, I'm not dead yet. I've been machine gun, handgun, hijack, left for dead. Dive bomb, napalm, nuclear warheaded. Dropped from a jet plane with no parachute. Shot by a firing squad and raped by a business suit. Dancing on a landmine, one leg left. I can still crawl and I'm not dead yet. Not dead yet. Not dead yet. I'm a mad dog fighting with the wall against my back. You better get a bigger gun, I'm not dead yet. Well, you're bigger, rougher, meaner, tougher, dirtier and uglier and sneakier and trickier. You wanna shoot me with a gun, cut me with a knife. Take your bare hands and rip out my eyes. Kick me in the balls and you bit me in the neck. Well, hit me again, cause I'm not dead yet. Not dead yet. Not dead yet. I'm a mad dog fighting with the wall against my back. You better get a bigger gun, I'm not dead yet. Well, there's a mugger in the alley, there's a sniper in the hall. There's a girl at the bar, wants to get me